The banking system is in a lot of trouble, and it's not just here, it's the entire world. But I don't think it's going to be an economic collapse similar to 2008, and I think the United States is going to come out stronger than ever. Bad news first. There are 1,804 banks and other institutions that are using emergency funds from the Fed called BTFP. It means Bank Term Funding Program, and it was set up last year in 2023 after the four big banks fell as a means for troubled banks to get emergency lending. Now, 95% of all of those borrowers have assets less than $10 billion. There are 4,500 banks in this country, and they are all interconnected. So even the good banks with perfect assets are in some way connected to a few bad banks, and if a huge chunk of these bad banks fall, that affects the good banks. And the reason why a lot of these banks, big and small, are in trouble is because of the commercial real estate market. Namely, the office sector, which is really only $3.25 trillion in its total value. Unfortunately, thousands of banks, big and small, are heavily invested in the commercial real estate sector, which has been dropping in value since COVID, meaning that these banks' loans and financial instruments based off of commercial real estate have dropped in value, making these banks operate at a huge unrealized or sometimes a realized loss. And there's the fact that since last year, the Federal Reserve implemented 11 interest rate cuts in, a year, a little bit more? That has rarely ever happened, and that broke some of the banking industry. Most of the banking industry buys a lot of 10-year treasuries, 2-year treasuries, 20-year treasuries, you name it. And when interest rates skyrocket, so does the yield of the treasury in order to stay competitive. The problem is, if the yield of the treasury rises, the value of that same bond drops in value. For example, if you bought a $100 treasury and then because the interest rate hikes, the yield goes up, but your treasury, if you wanted to sell it, is now worth $80. You would be selling at a $20 loss. And right now, just in the US, we have about $600 billion or so in unrealized losses. The saving grace is that they are only realized if you sell the asset. But the worst, most toxic thing, in my opinion, are the toxic assets from the Great Recession that have not been addressed in 16 years. I went on every search engine and looked as much as I could, and I could not find an exact amount of how much these legacy assets are valued. So I went to ChatGPT. The answer? As of the latest data available in 2024, it's estimated that a considerable amount of these legacy assets are still being held by US banks. However, exact figures are challenging to obtain. There is a lack of transparency in their valuation, but these two figures give me some kind of clue. TARP was $475 billion, but $245 billion allocated to stabilizing banks. The problem is, a lot of these assets were bought for, I believe, 100 cents to the dollar, while in fact, they're probably worth close to nothing now. Now, on paper, a lot of these banks look like they're in perfect health. Let's look at JP Morgan Chase with a balance sheet of about $3.9 trillion, and they have $1.4 trillion in cash and marketable securities. That $1.4 trillion fooled me. US Treasuries and mortgage-backed securities are technically marketable securities that can be sold on the market. But as we discussed in this video, those bonds would be sold at a loss. And I was fooled by this figure because I was boasting how Chase would be able to take care of a lot of their own problems. And guess what? It was really hard to find how much cash Chase actually had. So I had to go to ChatGPT and ask. They have something akin to $657 billion in cash. That's still a lot of money to scoop up any bank that's in trouble. But let's look at their balance sheet. Total equity is the most important aspect of any corporation's worth. It's something that you can write your losses off against, and it's something you can kind of leverage. Their total equity is $337 billion, and their balance sheet is, I was wrong, it's $4.1 trillion now, so technically they're leveraged maybe 13 times. And that's not bad because some banks are leveraged, 50, 80 times? Mind you, Chase has $173 billion in commercial property loans, so they're suffering from the CRE crisis as well. Now let's look at their assets. They have $231 billion in treasuries, which we know are at a loss. Mortgage backed securities, $217 billion. And we don't know if these are some of the old, toxic legacy assets from 2008. And then there's $596 billion in other investments. Chase has reported a loss of $40 billion in their held to maturity assets. That's the treasuries and maybe some of the mortgage backed securities that they talked about. But they are also holding a lot of the old toxic legacy assets from 2008 that may be worth zero, that they still get to value at 100 cents to the dollar. So that $337 billion in equity, well, you can write $40 billion off of their reported losses. That's $297 billion. But we don't know how many tens or hundreds of billions of dollars of loss that they're holding from these legacy assets. So maybe the losses that they can write against this equity total $150 billion, $200 billion, or maybe even more. Meaning that JP Morgan Chase is much more leveraged than they're appearing on their balance sheet. And this is one of the good banks. JP Morgan Chase is too systemically important. It won't, I don't think, collapse because it's just so tied in with government interests and the world. But there are hundreds, if not thousands, of other banks that don't have this much pull that are in a worse condition. And maybe you're thinking, well, the FDIC will bail out those troubled banks. The FDIC, as it is, has about $121 billion in it. There are $17.5 trillion of deposits in America's banks, and 60% of them are FDIC insured, so it's about $10.2 trillion that the FDIC has to cover. So there are 1,800 banks that are currently receiving BTFP because they're in some trouble. So if 1,800 banks fall, that's about 40% of all the banks that we have. And let's say 40% of the FDIC insured assets is $4 trillion. But let's say only 10% of the banks in the BTFP fall, 180 of them. All right, so that's technically $400 billion in assets that the FDIC would have to cover. But as of now, the FDIC only has $121.8 billion to it. And the Federal Reserve, which is the money printer of this country, reported that in 2023, their expenses exceeded earnings by $114 billion. So they're operating at a loss of that much money. And it's worse once you get outside the United States. China is going through deflation. They have a $23 trillion local debt bubble that has burst. Evergrande and other major developers and lenders have collapsed. Credit Suisse fell last year. Deutsche Bank is in a lot of danger. Japan's currency, the yen, is trading at a 34-year low. If the FDIC and the Fed, as it is, cannot bail out our banking system the way they've conventionally done, and the rest of the world is having a similar banking crisis, then the entire world is going to face a liquidity shortage. When I say liquidity, I'm talking about the money supply. You see here, this is the money supply of the United States dollar, and once the Fed increased interest rates very quickly, the money supply contracted a lot. People were actually worried that we were going to go into deflation. But if there is a banking crisis that is too big for the FDIC and the Fed to handle, then this drop in the money supply will look like a pimple compared to a knife. I'm not saying it would go to zero, but it would contract a lot more. Deflation, which is much worse than inflation, would rear its ugly head and wreak havoc on the world economy. I've made a lot of posts on deflation. You should look at the playlist, and I'll attach one of the videos here. But you forget what the most powerful entity is in the United States, and that is our government. The United States government and the Fed have been watching this phenomenon for quite some time. This isn't going to take anyone by surprise like it did in the Great Depression and the Great Recession. If you want to see the part 2 to this video, let me know, because that is going to be the good news and why I think we're going to get out of this. My name is the Geo Husar, and I'm actually optimistic about the future. Thanks for watching.